Test 1 2 3. Mic test 1 2 3. Yeah, so I'm Kelvin here. So yeah, just do a bit of sound check and screen check. So really appreciate that just anyone could tap over at the chat box. Could you see my screen? Yeah, as well as okay, good. So basically all right, excellent. So thank you for your feedback. So we can start in a couple of minutes time. So for those who have just logged on into this evening webinar, thank you for your time, ladies and gentlemen. My name is Kelvin. So basically we'll kickstart in a couple of minutes time, yeah? All right. Okay, good. So good evening, ladies and gentlemen. I'm Kelvin here, market analyst from CMC. So welcome to this evening webinar, which is pretty much important webinar. I would say that given the amount of attendees that we have, thank you so much for your support. And most importantly, everyone wants to know where will be the global markets heading into Q3, especially after the recent Fed FOMC meeting, where the Federal Reserve start to sound a bit hawkish, as in due to the guidance of bringing forward their first interest rate hike to 2023. Okay, and some of the Fed officials actually warranted an earlier hike to 2022. All right, so let's get started over here. So let me uh, okay. All right, so everyone will not get distracted for me. So I believe that everyone is able to see the screen over here. If those who can't see, just give a shout out over the chat box over there. All right, so before we start, as usual, disclaimer. Okay, good to go. So basically a brief introduction about myself and who am I. So basically I'm Kelvin. I'm actually the market analyst from for CMC Singapore. So I'm in the industry for close to 15 years. So prior to that, those who actually know me, I'm actually with City Index in the last 6 years, which is all a local, one of the top local CFD brokerage house in Singapore. So my expertise is actually looking at the market from an integrated approach, using technical analysis, gelling together with sentiment, fund flows, and fundamentals. So later I'll share with you all actually how to actually follow me on social media, because I'm actually very active on social media every day. I tweet every day about the markets on Twitter, and as well as I do educational trading videos that is published on CMC SG YouTube channel as well. Okay, so with that, I'll share with you how to actually access to this social media channel to actually get hold of this great content. Okay, so with that, right, before we actually start into the outlook of Q3, so I want to take into perspective of the global stock market first. So especially, right, if you all know that the current stock market has been ongoing since 2009 low, close to about 13 years or 12 years, give or take. Okay, so when will it end? This is a question that most people have in mind. So let's take a look back in previous circular. We talk about circular here, I mean long-term trend of the global stock market using the S&P as a proxy, because that's the earliest data that we have historically, and also the US market is still the most liquid market in the world right now. All right, so let's take a step back. All right, so we look at the previous long-term circular bullish trend of the US stock market. So this one over here is 1942. That means right after the Great Depression. Okay, all the way up to January 1973. All right, so this period of long-term circular uptrend, it lasted for 334 months with a return of 1,453. all right, during this period in time. Then thereafter, you have a correction. Okay, I would define as a correction of a long-term circular uptrend. That means a change, a reversal of long-term circular bullish trend is we need to have a correction of more than 20%. All right, we talk about more than 20% over here. So we have a correction about close to 50%, 49.9% between the peak of January 1973 to the low of October 1974. All right, then thereafter, from October 1974 low all the way up to March 2000. Okay, you realize that in between here there is no, it didn't have a decline of more than 20%. So I could say that between here to here means the October 1974 low all the way up to March 2000 high, we do not see a damage or a change in this long-term circular bullish trend at that point in time. So this long-term bullish trend actually lasted for 306 months, 2,384% return. Then thereafter, it actually plunged by 50%, rally up, but failed to break above the March 2000 high. This is the October 2007 high. Then thereafter, you all know that Lehman Brothers came in. It actually kickstarted the great financial crisis, plunged all the way down to the infamous 66666 low at March 2009. So they give you a plunge of 57%. So you could see over here, there's two episodes of severe actually a decline that actually punctured or actually reversed this long-term circular bullish trend. So we could say that the long-term circular bullish trend ended in March 2000 at that point in time from the start of October 1974. Then thereafter, it traded big sideways, a very big sideways, close to about 9 years, 9 years of sideways, where there is two episodes of more than 20% decline inside here. All right. So what we could say over here is that the low of 666 March 2009 actually kickstarted this current long-term circular uptrend. Okay, last right here, circular uptrend. That means talk about multi-year. We're not talking about intraday trend. Intraday as in by the hour or by the day. No. So we are talking about multi-year uptrend. Okay, so since the March of 2009 until today, which is yesterday's, this is yesterday because 29th of June 2021. For the period of here to here, we don't see any decline of more than 20%, which is 40% or so. So this ongoing circular uptrend is actually the shortest so far that I present to you earlier on. The previous two long-term circular uptrend since 1940s. So at the moment, in terms of magnitude and in terms of time, it's the shortest, 147 months. So far, only 545% return versus previously we see 2,000%, previously 1,000%, and the duration is much more. All right, compared to the current one right here, it's only 147 months. So definitely, a lot of people say that, hey, yeah, who knows, this time around may be different. You know what I mean? Because if you look at the current situation now, since March 2009 until now, there's the amount of debt level inside the system is much huge compared to the previous years. Yes, because of the ultra low interest rate environment that is driven by global central bankers, and also after last year pandemic, we see a huge inflow of fiscal stimulus. So all this money got to be repaid in the near future, right? So sooner or later, if there is an increase in interest rate, the debt burden will be much harder compared to the previous circular uptrend. Means the previous years, we talk about the 1940s, 1960s, 1970s, and early 1990s. Yeah, we could argue at that point in time. So to me, right, I would actually look at certain factors that are actually potentially that could cause a trigger in this ongoing uptrend. So you all know that how does a bull market run? Yeah, it run by fundamental, but most important thing is it got to be run by liquidity. That means there must be enough liquidity in the system to support higher prices. That means, i.e., interest rate cannot be too high, right? If interest rate too high, the liquidity will get sucked up and there will be less liquidity in the system to actually float to risk assets. So that's basically how markets work. Whether it float to, if it start to float to too speculative elements of it, the crash, the what you call it, the probability of hard crash increases by any little we call it a negative feedback loop. So one of the reason that we could look at over here is what causes liquidity to go down. It will be a rise in interest rate. So what causes interest rate to go up will be a risk of inflation, correct? So what causes inflation to go up? There must be something, right? It will be commodity prices like oil. So if oil keeps going up, and if you start to see right now food prices keep going up, sooner or later you and I will start to feel that our pay is getting lesser and lesser. All right, so at the end of the day, to curb this inflation risk or inflation pressure, global central bank got to withdraw liquidity from the system by hiking interest rate. Agree? So now, how do you monitor this play into the market? Is by looking at this chart. Share with you. Okay, before I jump into that particular, I talk too fast. Before I jump into that particular factor, right, where I monitor the risk, is let's take a look at the earnings first. Okay, so before talk about earnings, right, one factor of it is that we need to talk about fundamentals, right? So fundamentals so far has been pretty robust in Q1 earnings. We're talking about if you look at the US market as a proxy. So stellar Q1 earnings growth for the S&P 500 on the average 52.4% is the highest year-on-year growth since Q1 2020, compiled by FactSet. And among the sectors over here, the one that produce the highest return, or say the steepest rate of increase, will be the consumer discretionary as well as the financials, which both record triple digit year-on-year return in terms of EPS growth, earnings per share growth, 238% for the consumer discretionary, and the financials coming in at 144%. You see in this chart over here. Okay, so now how about the Q2 earnings estimate? So you all know that Q1 has already ended. So right now, Q1 earnings has already ended. So Q2 has already ended as well. Okay, because by end of June, Q2 already finished. So we talk about May, April, pardon me, April, May, June, that's Q2. And the US earnings season will kickstart for the reporting of Q2 numbers in next month, which is around middle of July, where the financials like Citibank, Goldman Sachs, JP Morgan, they will actually so-called officially kickstart the US earnings season. Okay, so before that, before they actually kickstart, the analysts on the aggregate has really started to estimate what would it be in Q2. Okay, which is actually we will know later in next month. All right, starting from next month, roughly around the consensus figure, whether they are right or wrong. So given the number of the current situation right now, all these analysts, they actually projected S&P 500 Q2 earnings growth to grow at 61% year on year. So if that were actually to materialize, so what we could see over here is Q1 already ended, right, 52.4. So Q2 they actually project much higher, 61% year on year. So if that were actually materialize or happen, it will be the highest level of earnings growth for the S&P 500, which translate to the US stock market as per se. It will be the highest level since Q4 2009, based on data compiled by FactSet. All right. So if you look at into this situation over here, it seems to us that the expectation for fundamentals is still robust. All right, based on this earning estimate as compiled by FactSet, which is positive for the stock market, because on one hand, to actually support higher price, yeah, we know that right now valuation is pretty high in the US stock market based on P ratio or based on whatever metrics you look at it, the valuation. If earnings starts to pick up over here, it justifies such PE. Okay, even though liquidity starts to actually tighten a bit. Okay, but the most important thing over here is inflation risk. All right, this inflation risk. So if you look at global manufacturing input costs, that means this is not consumer cost, it's what I call factory cost borne by businesses, corporates, hasn't passed down to consumer yet, but the costs by corporates are getting higher and higher since the start of this year. So if you look at the global PMI manufacturing index, there's this cost component compiled by IHS make it. So global manufacturing costs continue to be elevated. All right. So if you look at for the month of May over here, especially on the China PPI as well. So China PPI actually rose 9% year on year in May, above 6.8% year on year in April. So that is the fifth consecutive month of increase for factory costs. The cost of producing goods are coming out of China, and it's also the steepest increase since 2008. All right. So what it means over here is this: consumer consumer cost still remains capped because businesses are not willing to pass the cost to consumer yet. With what I call the risk, the fear of losing market share from their competitor. But what if business cost, which is as manufacturing, as shown by these two graphs of here, the global PMI, input prices, all these keep increasing together with China producer price index. So as you all know that most of our goods comes from China. Globally, they are still the I would say that, yeah, even though the market share has started to come down, but significantly they are still the global factory of the factory of the world. Still, I mean, to me, in terms of if you look at the relative basis, yeah. So in a way, directly or indirectly. So if these two figures keep on increasing, right, business costs will start to go up as well. So sooner or later, right, there must be a point where businesses got to pass on their higher cost to consumer. This is where we start to see a pickup in consumer price index, CPI index over here, which may we start to see already, especially from US, where their CPI and the PCE index, which is a gauge that's preferred, measured by the Fed, rose to above 2%, with 3% last month. So the thing over here is, a lot of us, some may argue that this inflationary cost, whatever this inflationary pressure that we see for corporates at this point in time is transition temporary. Okay, they clear the word temporary. That means based on lower base effect last year due to the pandemic. After all this adjustment has already been done, things will go back to normal. I mean, yeah, that's debatable. But to me, what I like to look over here is, I like to look at one chart that I share. So this is what it means. If you look at the price of commodity has gone up significantly, that is causing all this to go up, the business cost to go up over here. So what we could see is that, okay, this BBG is the broad-based commodity index that consists of energy, metals, and agriculture together. So you lump them up together, you see that year to date they closed about 18%. So this is based on data on 20th of June, about two weeks ago. All right, or a week ago or so. 18% year to date. All right, so the one that is causing the highest impact will be energy price. Okay, 51% for WTI crude. Then we're talking about 46% for Brent crude. All right, then metals as well. Copper, all this. Despite China starts to slow down a bit, to control the price of copper in a way by providing a bit of guidance. Okay, either direct or indirect guidance. It's still high at 20%. Okay, agriculture, almost double digit as well. Your coffee, your soya bean, all this. So one thing that is lagging behind will be your precious metals, which is gold is still negative 6%, silver negative 1%. That is still not picking up. All right. So the rest of the commodity space, right, especially energy, is the one that is driving this heightened inflationary pressure. All right. So let's take a look at this chart, which is an important chart that I will monitor every week and every month to see how it goes. Why is it important? Because, okay, let me explain to you all slowly what this chart is about. All right. So this chart, right, is a long-term relationship between the Bloomberg Commodity Index. That means I take the commodity index that comprises of energy, agriculture, metals, together with soft commodity together, and I plot the relationship with the S&P 500. All right. So going back all the way to the 1940s. Okay, so unfortunately, the Bloomberg Index only started, the Bloomberg Commodity Index only started in 1958. Unfortunately, it didn't go back much further. Okay, so what we could see over here, there is a decline, right? 1972 to August 74. So this is a steep circular correction of 42% seen on the S&P. Okay, so before this steep circular correction occur on the S&P of 42% during this period of December 72 to August 74. Prior to this correction, these two dotted line here, you realize that this line here is doing an opposite of what the S&P is doing. Because the S&P now is doing a higher high, hit a peak, collapse. So higher high, but this line here is doing a lower high. This is called a divergence. So what we could see on negative divergence. So actually, what is this line? So this line is actually the ratio of the S&P 500 divided by the Bloomberg Commodity Index. So what it means, if this line is declining, it means that everything is about second order derivative rate of change. So a rate of, that means we're talking about the rate of change of S&P is lesser, is increasing at lesser compared to the rate of change in the commodity index. That means commodity prices are increased at a faster rate versus the S&P. So very simple, if you want to measure anything that is leading, right, everything boils down to rate of change. All right. Okay, so far so good. So I think somebody asked me some question about gold and silver. So maybe let's take that maybe towards the end of the seminar. All right, toward the end of the webinar, so it's easier for us to do a Q&A. All right. So now, if you will look at this period in time, this is the August 2000 to September 2002. There's a decline of 41%. So prior to this decline, there is a negative divergence as well. All right. August 2007, February 2009, there's a decline of 49% in the S&P. Prior to this decline, there's a negative divergence as well. All right. And what's interesting over here is this. Since the low of the 666 low of March, all the way until now, where the S&P started going up all-time high, higher and higher, means this is the long-term cyclical uptrend, it came to the beneficial of what I call a deflationary environment where commodity prices are going down lower and lower. And recently, at the start of this year, there's a change of trend. It actually did a bullish breakout. And this bullish breakout now of the commodity prices is causing a negative divergence to be formed. So that's a red flag. That means what it means now, the commodity prices is actually rising faster than the rate of the S&P, of the increase in S&P. So far, so good. So what it means that there's a negative divergence being formed, that what we see is similarly as a leading indication or leading signal of prior significant correction on the S&P. In October 2007, February 2009, August 2000, and December 1972. Okay, so far, anybody not sure what the hell I'm talking from here before I move on to another chart, because this chart is very important and the analysis is very important. So far, so good. All right, so I assume that everyone understand what I'm talking about. Now, yes, someone asked me how long is each divergence. So this is going to tell you there will be a leading time of this divergence that we got to be aware of. All right, so now let's go back to the previous one, which is called a lead timer. The reason what I mean by lead time is this. Lead time is over here. Once the first divergence that is being formed, how long before S&P reach the peak of December 72 and it start to crash? Okay, so taking at the first one, there's a lead. Okay, so basically, right, the first the divergence was being formed in April 1974, then all the way up to April 1971, pardon me, then all the way up to December 1972, the peak of the S&P. So what we could see over here, that when the divergence is being formed here, there's a lead period of 20 months. Okay, so divergence formed 20 months later before the S&P hit the peak. Then thereafter, it did a correction of 42% based on this period here. All right, now let's look at the one June 1999 to August 2000. Okay, so this is the peak here over here in August 2000. So in August 2000 here, the peak of the S&P, taking into account that the first divergence that's being seen, there's a lead period, the divergence period, the lead period, divergence period lasts for 14 months. All right. Okay. Then from here, October 2007, February 2009, it fall 49%. Okay, 49% over here. So prior to the October 2007 peak, the lead period was 9 months. So the divergence, but once the first divergence is being formed, it took 9 months for the divergence to play out before hitting the peak of October 2007. Then thereafter, it plunges 49%. Okay, so far so good. So what we could see now is 20 months previously, 40 months, the period, we're talking about 20 months, the period of divergence. Once the first divergence is being spotted, it lasted 20 months before it hit a peak of in December 1972. This one 40 months before it hit the peak of August 2000, and this one the divergence lasted for 9 months before it hit the peak of October 2007. All right, so right now, right, currently what we see now is the divergence, right, started from the period of November 2002, this November 2002 to March 2021. Okay, so lower high, it started over here. So for March 2021 until today, June, this April, May, June, so it's about only 3 months so far. All right, okay, so 3 months so far. So given that at the moment in time, right, if I were to look back in the previous historical movement of the lead period in terms of divergence, right, so far this one is the shortest. So on the average, what we could see is that perhaps we got another 7 or 8 more months to go before potentially this long-term circular trend hit a potential peak. All right, so far so good. So what we could see over here is that it's only 3 months. Yes, the first sign of warning is there, but it's only 3 months. Okay, clear. Okay, now another indicator I look at over here is the global financial stress index. So it's an index that measures liquidity in system. So this global financial stress index compiled by Bank of America Merrill Lynch is actually a composite of index that an index that comprises of the VIX, your bond, your what I call a corporate bond yield spread. Okay, VIX as in also the volatility inside the FX market, the volatility inside the stock market. Okay, and also fund flows. Okay, so if you look at it over here, 0.63 is the kind of the median for where the where it started in 2000. So if it goes above 0.63, this is where we start to see a spike in where liquidity is very tight, where it may lead to a risk-off scenario. So this happened over here in recently in the early part of 2020. Okay, then thereafter it started to comes down. All right, which shows abundant liquidity at this moment in time. All right, so this abundant liquidity over here in this at this point in time, right, what does it mean? So what it means that over here liquidity is not tight yet, and also if I were to base on the period of Z score, because we all know that if liquidity get too abundant over here, it will not remain abundant for a period of time. So this is like a rubber band, So once it hit a low level, right, there's a big risk that it may start to bounce back up. Okay, so if you look at this point in time, right, the Z score of the current level of this current of financial stress index, which is at negative 0.9, the Z score is not at the extreme low level of -2 and below. So what it means that liquidity is abundant, but it has not reached an extreme abundant level where we will start to see a mean reversal back up. Okay, so what it means over here is the global liquidity condition remains abundant. That means it's not tight, and it's also not too loose that is at some extreme level that we need to be aware of. Okay, so at this moment in time, we have liquidity that is still supporting risk on behavior, plus the warning from the negative divergence of the S&P and Bloomberg Commodity Index ratio hasn't hit a lead time that has happened in the past that trigger a substantial correction of 40% or more. Because now the lead time is only 3 months. In the past few months, the past 3 episodes, it has a lead time of more than 10 months, all right, on the average. Okay, now diving into the various sector. Okay, now I'm not talking about sector performance. So we know that we get it clear. Fundamentals is still supporting risk on behavior. The two chart I share with you, the interrelation between S&P and the what I call the commodity price index, as well as liquidity, is also still supporting risk on. Okay, so we set that in mind. So now the next thing over here is that we ask ourselves is, what are the sectors that we should be focusing on? Because we talk about S&P so big, right, as a whole, it's a big market. So within S&P, there's 11 key sectors. We break down 11 key sectors all the way from here, 11 of them. Okay, this is a source from barchart.com. You all can actually take a look at it. It actually provide the performance of this sector, and it's free. So this one is 2021 year to date. As of 29th of June 2021. Okay, very recently only. S&P 14%. All right. So if you look at the top sector that is performing is the energy and financials. So those who actually listen to my Q1 and Q2 outlook, we have been advocating energy and financial as outperformer. All right. So these are what I call the cyclical and value play, which is actually going in line with commodity prices increase as well. All right, so the one that is not so healthy is the information technology, 13%. Okay, no, sorry, it's utilities, pardon me, utilities, consumer staples, consumer discretionary. So all these are at the bottom. But if you look at previously, right, information technology, those who follow the market, right, we talk about big tech stocks, semiconductor, all this. In the month of April, pardon me, at the start of somewhere around February this year, they actually came down quite a fair bit. And it's only recently they start to outperform. That actually pushes them up from the bottom to the mid table. Okay, so this is very obvious that if I would now show you the running 3-month return as of 29th of June, you realize that technology is actually one of the top performer. Where else? Energy, the cyclicals, materials, industry start to fall at the bottom. Okay, in the last 3 months. All right, so they start to actually decline. So later I'll show you another interesting chart. What causes them to actually decline from here? Okay, now before we go into the sectors, we look at different factors. Okay, now previously we talked this is sectors. So now we're going about style factors. So you all know that there are various style we can look at. There's high in US, right? The US market is split according to 1, 2, 3, 4, 5, 6, 6 different style. High beta as in, what I mean by high beta? High beta as in we can look at it as something related to reflationary play. That means if S&P go up by 1%, that particular stock or sector goes up more than 1%. And if S&P drop by 1%, it goes down more than 1%. Okay, this is what I mean. So there's this ETF or an index, we call it an index that comprises this high beta stocks together. So they actually become an index. So we call it the ETF. So it's listed on the exchange, ETF. So what I did over here is just basically getting the index ETF divided by the S&P based on the various 1, 2, 3, 4, 5, 6 style. So definitely you have value. So value will be your cyclical with your cyclical stocks always considered as value. Then you have your growth. Growth will be considered as technology, and some even much more innovative one like EV, all this. Then you have high quality. So high quality consists of stocks that are they're actually dependent on, let's say for example, lesser leverage, I mean lesser debt, low debt ratio stocks. Then you have momentum stocks. So momentum stocks can be consist of growth stock or value stock that is actually moving. That means just purely based on rate of change. Then they construct this this ETF. Then you have low volatility. So low volatility can be considered as your defensive stocks, like utilities or some of your consumer staple stocks. So at the bottom, I plot in the US 10-year Treasury yield. I want to share you the relationship with them. So what we could see over here, this relationship is very, very interesting. Is this? You'll realize that since the start of this year, the US Treasury yield starts to go up higher. All right. So once this US Treasury start to go up higher, it actually helped the high beta stocks, which is going up as well. Not so much. Also, the value also went up. Notice that. But the growth got hit. It went down. All right. Then high quality, nothing much. It just goes sideways. Momentum went down. Okay, it went down from here. Then low volatility, nothing changed. It just be a bit of sideways movement. So one thing difference over here is that the increase in the US 10-year Treasury yield actually push the high beta stocks to go up, push the value stocks to go up, but growth stocks to come down. Then the rest is momentum stock to come down as well. High quality, nothing changed, sideways. Low volatility, no much significant changes. So a lot of us, why I'm looking at this US 10-year Treasury yield, because it measures a lot of things. Okay, this US 10-year Treasury yield is actually a measurement of what I call growth, one thing growth, and also a measurement of potential inflationary pressure coming into the picture. Two story. So let's say, for example, if this US 10-year Treasury starts to inch up higher, it means that growth is coming back into the market. That's why the Treasury yield goes up. That's 101, because there will be a shortage. People will not want to buy Treasury bonds for safety. So they will actually switch their Treasury bond out to other asset classes. So if bond prices goes down, Treasury yield will go up. So that's an indication of growth, and it's 10 year. It's not 2 year or whatever. So we're talking about a longer picture of growth, include our growth as well. So another factor is that if the Treasury yield goes up, yields go up. So what it means potentially inflation may come back into the picture, where it may cause a tightening of liquidity condition that could dampen growth stocks. So that's why growth stocks actually goes down. Why growth stocks goes down? Because growth stocks tends to have a higher leverage. That means they tend to take more debt to actually grow their business. All right, so that's why growth stock went up. Then why value stocks goes up? Because value stocks is related to cyclical play. So once you related to cyclical play over here, with the increase in US 10-year yield, that means there is a potential reflationary theme into the market of growth coming back into the picture, which is true. Why? Because at the start of this year, everybody is talking about global reopening of borders, also talking about fiscal stimulus policy from US gaining traction and globally. All right. Okay. So with that in mind, right? Okay. How about those growth stock with no gearing? Okay. So now I'm not talking about individual stock. Yes, growth stock with no gearing. Okay. So I'm answer this case. When there is a market correction, severe market correction, there will be indiscriminate selling. Example, if we were to look at the most recent one in the global pandemic, okay, global pandemic, right? So once there's a shock in the system, all stocks came down, including those stocks that have growth stock with no gearing. No gearing is very low gearing. So I don't believe there is company that has no gearing. There is company with gearing, but it's so lesser that you look at it, almost all stocks comes down. It only that depends whether they come down more or lesser. All right. So the clear thing over here is this. I got to actually tell your mind is that once there's a market shock, that causes the market to do a severe correction of more than 20%, all stocks will be impacted, irregardless whether the stock has low gearing or high gearing. There's no such, there's no, I believe that there's no company that's no gearing. All listed company, there will be gearing. It's only that whether less or more. It's only that they fall lesser, that's all. But they will still fall because of indiscriminate selling. So an example, you could look back at the pandemic crisis. Last year, all stocks came down. I don't see there's a potential stock that actually go up. In fact, as a whole, most of the stock came down. Very, very rare you see a stock will go up. So unless that stock is very, very liquidly possible, unless that stock is very liquidly thin stock that is not tradable, lesser liquid in the market that doesn't attract much trading volume. Okay, so that's a different story, a different point of the play. So that's more about picking this kind of value, what we call value stocks, whatever. All right, but in fact, most of the stock that are liquidly traded in the market will come down. All right. So now, how about the next? If I will take it year to date, okay, year to date. So year to date as of 23rd of June 2021. So if I were to look at this scenario here, I zoom it out. Right? So do you know that from April until now, the US 10-year yield starts to come down. It starts to have a slow, gentle decline. So in this slow, gentle decline, you realize that your high beta stock here that is outperforming also start to dip slightly. All right, your value starts to decline. Your quality starts to pick up slightly. And what's interesting over here is that your growth and your momentum starts to pick up significantly. All right. Okay, then your low volatility starts to, I mean, there's nothing much. I start to just a big, it's kind of sideways formation, inch down slightly lower. So what it means that over here is the 10-year Treasury yield is coming down. What it means that two things the market is interpreting right now. That reflationary theme in the market right now seems to be slowing down since April. All right, means the reflation theme seems to be down since April. One possibility that we could argue that why is it slowing down, because of the risk of central bank tightening the liquidity. That means through QE, reduction of QE and potentially interest rate hike. That's one reason for that. That's why growth came down a fair bit. And also, if this come down, that means we're talking about inflation expectation also inch downward because of central bank policy that may get tighter in the second half of this year. So if central bank policy get tighter in this second half of this year, and it will lead to a kind of slowdown in growth. So a slowdown in growth over here, what you could see over here is that the reflation theme starts to dip down. All right. But however, high quality, which is stocks that are lesser debt, goes up. It makes sense, right? Because if central bank would tighten, that means liquidity gets tighter, interest rate goes up, definitely stocks we have lower gearing ratio will benefit. That's why high quality go up. Then how about growth? Why growth goes up as well? Okay, so now the story comes to here. At this moment in time, this slowdown in the 10-year yield also could be attributed to the risk of COVID-19 different strain that is spreading in the world right now. We talk about the Delta strain. Potentially, if it starts spreading over here, there will be a risk that the current vaccine may not be as useful as it's assumed. Reopening of borders, reopening, relaxation of economic activities may not turn out as fast as it wants to be. So that will lead to be a slowdown in growth, which is actually beneficial for growth stocks, especially on the technology space. Okay, so they could actually thrive in the period of lockdown. Agree? For certain technology company. Okay, so momentum also start to pick up. Why? Because momentum is also a growth stock play. Notice that the momentum and growth stock, they're actually moving in line. Okay, so what you see right now for sure that quality, growth, and momentum are actually performing reasonably well in the last 3 to 4 weeks. But value starts to come down. That means you're talking about your financials, your cyclicals, your materials, your industrials has starts to underperform together with line with the high beta. So what market is actually inferring right now is that because of the slowdown in the US 10-year yield, that causing this impact on the market to believe that, hey, growth might start to slow down due to the risk of tightening. And this tightening thing also boils down to the fact that, hey, there will be a potential slowdown in the expectation of economic activities resuming back to normal again, which is beneficial to technology stocks. Because if there is no resumption of as it seems, but they will still need to do stuff, right? But they'll do it more remotely, which is benefiting the technology stocks. All right. Okay, now this is what it means over here. So this is a clearer picture here. If I will take into account of the 10-year minus the 2-year spread, the 2-year spread inside right now. Okay, so if you look at it over here, okay, so this is what I call energy, industrial, bank, materials. So all these are your cyclical and reflationary team play that has been going up since the start of this year. Okay, if you look at the energy with this line, banks, the blue one, industrial, materials, the orange, all of them has been going up very sharply, yeah, since the start of this year. And if you look at it right now, the movement of them moving up is actually in line with this red line, which is the 2-year, the 10-year minus the 2-year spread. Okay, so what is the spread? It's actually the rate, the 10-year yield minus the 2-year yield. Okay, so if this line here starts to goes up, start to increase, you realize that intermarket relationship actually is supporting this cyclical or reflationary team play. And you realize that since 15th of March until now, it has started to come down. Your energy, industrial, and bank has started to come down a fair bit as well. All right. So what it means that over here, it actually explains to us the current underperformance of your cyclical stocks, as you all see in the last four months or so. Sorry, not 4 months. The last 4 to 5 weeks or so has been caused by the US 10-year yield spread over the 2-year that is inching downwards. So what it means that it actually tells us one thing, no, the 10-year is actually coming down much faster than the 2-year, which is not that good. So we're talking about the growth or the reflationary play in the economy itself. The market doesn't seem to believe this anymore as priced on the US 10-year, 2-year spread. And technically, there's a momentum factor that drives it because of this bearish signal on the MACD, which is the trend indicator, indicate to us there's a turn of this previous uptrend to a downtrend before hitting the support line with some more way to go of this 10-year minus 2-year spread. So what is still not hasn't turned out is energy price. Okay, part of the energy ETF, the energy stocks that is still resilient despite the 10-year, 2-year spread as it turned down. So one of the reasons why energy stock is still holding at the moment, I believe, is due to oil prices, which is still on the uptrend that is supporting directly your energy stocks. But the other cyclical play, your industrial, your bank, and your materials, has really starts to turn down from its mid-March high. Okay. All right. So now, if I will mirror it right at this point in time, since 15th of March, where the 10-year, 2-year spread has started to turn down, it actually benefited these three sectors your information tech, your consumer services, and your consumer discretionary. Later I'll talk more about the consumer discretionary. You realize that same thing from the 15th of March over here, where your 10-year minus 2-year spread starts to come down. You realize that your information tech, your communication services, which is considered as a technology play as well. Why? Because communication services consist of stocks like Facebook, Google, then you also have Zoom inside as well. Another technology stocks will be your esports, e-gaming stocks like EA, Activision is all inside as well. Has been going up steadily, making new all-time high recently. Whereas financials, industrial and material is not doing all-time high. And even energy is not doing all-time high. Yes, it's still attempt to push up, but it hasn't hit the all-time high yet. No, that hasn't hit the year break above the year-to-date high. Pardon me. All right, but the rest, information tech, communication services, and consumer discretionary now pushing up behind to wanting to make a fresh all-time high. So now the key thing over here, okay, why consumer discretionary is moving in line with this communication and info tech? Okay, the big reason why is because Amazon.com is the highest weightage inside the consumer discretionary ETF that causes it. So your consumer discretionary ETF is that consists of e-commerce company, Amazon, which has the highest weightage, which is so that's why it's driving this consumer discretionary ETF to go up as well. So it's all about tech play. All right, tech player. So what you could see over here is high quality tech. I would say high quality tech that has perhaps lesser debt ratio due to the impending risk of a what we call further tightening into system by more potentially hawkish guidance after the second half of this in the second half of this year by the Fed. All right. So what we could see over here, this yield curve now is actually having an impact on the sector rotation play going into Q3. So what I call that in this coming Q3, we are actually expecting underperformance of the earlier outperformer, which is this three, 1, 2, 3, 4, these four of them. Energy, I may be a bit hesitant right now to be an outperformer because sooner or later it may follow, or it may just go sideways because it's being supported by higher oil prices. Okay, so all this, your earlier outperformer might start to take a back seat already in Q3. What else? Your Q1, Q2 underperformer now is actually about to shine in this coming Q3 due to the yield spread that is coming downwards, supported by the yield spread. So what I could see over here is I will actually take a look at a share basket where CMC has it. It's a collaborative technology share basket. So over here, it consists of Microsoft and some other bigger US tech stock. So if you look at the momentum what we see over here in the since May low, so we could see over here since 16th of Feb, right? So this is what happened now. Since 16th of Feb all the way down to May here, it's been underperforming, trading sideways, whereas your cyclical stock has been going up higher. Okay, that's represented by Dow Jones. Dow Jones actually made new high in May. All right, so now it's only recently after 12 May, it starts to inch up higher, and recently it made a new high. It broke above this 3-month range recently. So what I could see over here, I have a key support here, 9226. Potentially, if this support holds, it could actually inch up higher to the top of the channel, which is 11,610/11,780. All right, for this our CMC share basket that consists of under the theme of collaborative technology. The next one I'll share with you will be esports. So it consists of the esports ecosystem, which consists of some semiconductor stocks like Nvidia that is supporting this esports industry, and definitely talk about game publisher as well like Take-Two and EA. So if you look at it over here, it's very similar from 16th of Feb all the way up to 13th of May. It has been underperforming the general market, going sideways. Then thereafter, after hitting the lower boundary of this ascending channel that is running in place since 17th of March 2020 low, it has been inching higher, and it did a bullish breakout recently as well. So the key support will be 7190, which is the pullback of this former range, and as well as the ascending channel support over here. RSI, a measurement of medium-term momentum, this is daily RSI, has been doing higher low, and it hasn't reached the extreme overbought zone yet. It indicates to us that the current momentum is not overstretched. So we are still looking potentially for a further push up as long as 7190 holds to go up higher to 8,340, potentially 8,800. With the key support, this level must hold at 7190. Okay, so another picture, I believe that some of them begin concerned about this technology space are mentioning more about technology stocks that are listed on the US exchange, means considered a part of the US big tech family. How about China big tech? Okay, so bear in mind 16th of Feb, you look at these two, you actually pick at 16th of Feb, then go sideways, right? If you look at China big tech at measure by Hang Seng Tech Index, which is a composite of China big tech, the key China big tech is that also very similar. It peaked at 18th of Feb, give or take, two days difference. So it peaked at 18th of Feb, post after the Chinese Lunar New Year break, then thereafter it just staged a decline of 32%. It's actually underperformed as well, but this one underperformed worse compared to US big tech because of the regulatory measure, or the kind of, not say regulatory, the approach taken by the Chinese government towards China big tech, such as Alibaba, Tencent, all those regulatory measures start to come in. But if you look at recently, right, the price of technically, I just look at the technical chart, the price of Hang Seng Tech doesn't seem to go lower. And in fact, it seems to me that after hitting a key support at 7,500, so what 7,500 is actually the ascending trend line support linking from the start of this index, which is announced on July 2020, where they get publicly traded in the market, and as well as 76.4% retracement from the low of January 2020 all the way up to 18 Feb 2021. And what it do, it form a bullish daily hammer, and it start to trace out a inverse head and shoulder formation. Technically, RSI, a measurement of momentum, start to improve as well. Prices start to show a bullish divergence, where you start to see lower low but higher low on the RSI. And this RSI also staged a bullish breakout recently from a significant corresponding resistance. So this rate of change, very much, like I said over here, to order to have a bit of, how to say, a bit of knowing where the market is about to turn, where are the key turning points, you need to know what's the rate of change rather than looking at absolute level. So the rate of change as measured by the RSI seems to be improved on the positive side. So what we could see over here is that we have a neckline resistance of the head and shoulder, even at 8,820. So as long as this key support hold at 7,500, if we have a breakout above 8,820, we could at least take it up to 9,450 / 7,650. So that I'm actually watching this level as rather closely as well for the China big tech stock, which it seems to me that the previous underperformance has started to ease off as well against the broader market. All right. So what we could see right now is, in terms of team play, growth stocks in the space of tech is actually now potentially leading the market in Q3. All right. The one that is taking a bad seat will be your cyclical and value stocks. Okay, so I'm not thinking that cyclical and value will crash, but I said that they may just go sideways, or they may move up as a slower speed, right, based on the reason that I shared with you earlier on. Okay, so now very quickly, let me take you through the technical chart or technical outlook of the various key indexes. Okay, like cover. So before I go into the technical chart, a quick scorecard over here, Q1, Q2 to date, and year to date, because now I do it on 25th of June, because the exact Q2 only ends today. Okay, by the time I do this, it's too late already. Okay, so if you look at it over here, Q1, you see Q1 over here. Q1, if you look at the US 4 main indexes, the one that is outperforming here is your Russell 2000, and especially your Dow Jones. The one that is underperforming is your Nasdaq, where is your heavily weighted on tech. So you could see over here is that Q1 is actually the outperformance of cyclical. which is heavily weighted on the Dow Jones Industrial Average. But the picture starts to change in Q2. You realize that Q2 over here, your Nasdaq 100 starts to be the outperformer, 7.62%. Okay, only 3.86% on your Dow Jones and 3.57%. Okay, so what you could see over here is a big change. All right, definitely Hang Seng Tech is still negative. Okay, because there's still sideways over here. So very quickly, right, if you look at Q2 to date, the one that is outperforming is one that has the highest green, your Nasdaq, your S&P. Because S&P, why? Because S&P, the three biggest weightage stocks is your Apple, Amazon, and Microsoft. Okay, that explains why of their outperformance as well. And also ASX 200, 7%. Okay, then over here, what I did over here is that I branch it. This is Europe. So this Europe, I put it in US dollar to actually remove off, to actually, how does I put it? To actually make it a more uniform comparison with the US indices. Because if you look at all these index, especially German index, Australia, all these, and Singapore STI, all these are listed in local currency. Okay, so it's almost the same. But one thing, especially Singapore. Okay, look at Singapore. You look at Singapore, right? Previously, Q1 they are the top performer together with Dow Jones. Why? Because Singapore is actually heavily weighted by our three banks: DBS, UOB, OCBC, which is considered as a cyclical play. But if you look at Q2 today, they are actually one of the worst, the underperformer, negative 1.89%. Why? Because our three banks actually underperform because of the earlier scenario I shared with you, the 10-year, 2-year spread that is coming down, that's causing the underperformance of banks. All right. Okay. So now let's quickly go on to this S&P 500. Okay. So this is a recap of Q2 2021. So at that point in time, I have a key support at 3,510 for that quarter to hold. So in between, right? Okay, this is quarter, not weekly outlook. So this outlook lasts for 3 months. So before I do my short-term outlook, right, even some of my weekly strategy, I need to decide what is my key support level and what is my longer-term trend for the 3 months running. So at that point in time, that 3 month for Q2 is, as long as 3,510 holds, it will be still a bullish trend for the S&P for 3 months. Potential target resistance will be 4,450, 4,630. Okay. Bullish breakout from this expanding wedge. We could see over here. RSI at the point in time was pretty healthy. Okay, so that was 7th of April then when I did my Q2 outlook. So now let's take a look at Q3. What will happen next in Q3? Okay, so prices eventually go up, right? So this is the monthly chart. So now the pullback support of this former expanding wedge resistance turns into a support, will be at 3,800 over here. RSI, nothing scary, overbought, but there's no bearish divergence at all. Hasn't reached the extreme overbought level yet. Okay, so for this coming quarter, I will actually tighten the key support to 3,800, which also correspond to the 50-week moving average. Okay, so as long as this level holds here, we could actually see further potential push up towards 4,500, then thereafter 4,630 for this Q3. All right, now going on next to the Nasdaq 100. Okay, so Nasdaq 100 over here, Q2, the time I was very hesitant to turn bullish, I just go sideways. So it actually, because there's a bearish divergence. So the whole of Q2, it didn't break above 14,040 if you go back to the chart and take a look. Okay, so at the point I was neutral, but for Q3 now, very clearly that last 2 weeks, it actually did a bullish breakout. Okay, from 14,040, right, exactly 14,040. It did a bullish breakout from here. So for me, I'm more confident to validate a bullish move, and the bearish divergence has been negated. So what I could see now is actually a potential melt up in this Nasdaq 100 resistance 15,130, 16,630 / 16,630. 16,630/16,830 level. Okay. RSI just did a bullish breakout, indicating to us that the rate of change, the rate of the momentum is still healthy right now. Key support to watch definitely will be 12,400, which is the 50-week moving average, as well as this swing low area over here to maintain this potential further up move for Nasdaq 100. Now, Dow Jones. Okay, so at that point in time, Dow Jones, I have 29,400 as my long-term pivotal support, looking for a push up towards 37,050, 30,450. All right, so now this one here, definitely this thing cannot crash, because all US market goes hand in hand. So what we could see right now over here is actually underperforming compared to the Nasdaq 100, which is now doing all-time high already. This has a do all-time high, and the S&P is also doing all-time high because of the three biggest weightage big tech stock inside S&P: the Apple, Facebook, and Microsoft. Whereas Dow Jones is heavily weighted more to the cyclicals. So this one it's more like a slow churn up. So I'm still expecting for it to do all-time high because all stocks got to go hand in hand. I cannot be expecting Dow Jones to crash. I know. I don't expect Dow Jones to crash. It's that it goes up at a slower speed. And what we could see now is the RSI is still pretty healthy, bouncing off from a significant support zone over here, indicating to us that momentum is still pretty much positive. So still no 3,000, 31,200 will be my key support for this quarter, Q3. Looking for this continuation of this uptrend to actually test the next resistance at 37,050/38,450 level. All right, so 31,200 is so the former expanding wedge resistance now turning into a pullback support. Now also the 50-week moving average, so acting as support over here, which is actually managed to act as support previously when the price came down in the early part of this year, last year, in somewhere around June last year. All right, now Russell 2000. Okay, so Russell 2000 at that point in time, I turned neutral as well, together with the Nasdaq 100 between 23,067 and 20,065. Okay, that was in 7th April. I turned neutral. So what are the elements right now? Okay, so this is the 20. Okay, why I plot this moving average is the 20-week moving average that is supporting all the dip previously. So it also supported that dip that we have in Q2. So right now, right, if you look at so far, it has been supporting all the dip, and right now it's attempting to push up. And what you could see over here is this bullish divergence here, or bearish divergence, seems to be getting weaker. Why? Because of there's a rebound. It has already came down and it tested the support and it started to bounce out. And now with the prices start to shape higher low, and we see it keep testing the 20-week MA as the support level. Notice that. So what I could see now is that 20,665 will be my key long-term pivotal support level. It got to have actually a weekly close above definitely this figure level 2367 to actually to validate a further potential move up towards 2460, then thereafter 2640/2755. All right, so far so good from here. Okay, so at the end of the day, right, the one that is outperforming is the Nasdaq 100 big tech. The rest, it will not crash, it will just follow suit, only that it will increase potentially at a lower pace or speed. Hong Kong. Okay, so Hong Kong 50, the Q2 outlook at that point in time was using 25,760 as my long-term pivotal support. Still looking for that push up towards this top of the channel here at 31,890/32,300. We're so close to the all-time high that was printed in Jan 2018. So what happened thereafter next as travel? You realize that at this point in time, the whole of Q2 it just goes sideways. Okay, it just goes sideways from here. So definitely the key resistance is still inside this big range of 31,890/33,525. So this is the monthly chart. So if you go to the weekly chart, which is the strategy for this quarter, my Q3 quarter, you realize that it just goes sideways for the whole of Q2 with a range top resistance at 29,575. But what interesting over here is that it did actually go lower and it start to shape higher high. All right, it start to bounce. So what you could see over here is I will not change anything because it just goes sideways for Q2. So using that 25,760 as my key long-term pivotal support to support my this bullish buyers for Q3, it got to break above 29,575. All right, and what's interesting over here is it seems to me that this previous move here that is coming down has already stopped at this point in time at the 50-week moving average. And if you look at the RSI also came down and test the corresponding support level, which is the former resistance, now turns to a pullback support and starts to shape higher low. So what it means that in terms of rate of change or momentum has started to pick up on the positive side by this observation over here, as indicated by the weekly RSI. So to me, but it got the price action got to break at 29,575 to go back up towards my initial the initial expected push up, which is 31,890 slash 32,300 on the Hong Kong 50. All right. So someone asked me about is this session recorded? Yes, it's recorded. And towards the end, I'll share with you all where can you find the recording. Okay, but I got to post the recording with tomorrow. All right. So now Japan. So Japan 225, right? Ever since it hit the February high, which is 30,490, which is also the a 31-year high. So that was the weekly outlook. So what I did over here is that I'm expecting a bit of pullback over here to 38,300. As long as this 26,880 hold, I'm still expecting a bullish bias upwards. Okay, why I'm still expecting a pullback? Because of the RSI is actually coming down from the overbought region and is yet to test the key support at that point in time. So right now, right, so what you see so far, Q2 is, yeah, the pullback actually took shape. The pullback actually take shape as expected. And what you see now, the RSI actually came down and test and bounce off from the support level. Okay, it bounced off. So it indicates to us that the rate of change starts to turn positive in terms of momentum wise. So because it just tried to it actually pull back the kind of did a pullback for Q2 and it didn't go much higher. So I don't want to be so aggressive and push up the key pivotal support. So it still remains at 26,880. That was my key pivotal support. So still looking from here to do a potential shape up. And what interesting over here is start to show higher low right at the 50-week MA that is supporting prices since June last year. All right, supporting last year. So right now a break above 30,490, potentially it could do a test higher towards 33,520 slash 34,050 as long as 26,880 long-term pivotal support holds. All right, now Australia. So you look at Australia, very bullish. Why? Because it break off a close to, I would say, 13-year-old range configuration that is in place previously from November 2007 high at 6,850. It did recently just did a bullish breakout. And the next resistance, right, will be at the top of the channel, also a Fibo expansion level at 8,020 slash 8,480. And your RSI still has much room to go before hitting the extreme overbought level. This is on the monthly chart. So for the strategy for this quarter is I'll be using the lower boundary of this channel, 6,850 slash 6,800 as my long-term pivotal support to have a bullish bias for this coming quarter Q3. So as long as this 6,850 slash 6,800 level holds, potentially you could see further potential movement push up towards the next resistance at 7,950, then thereafter 8,200, Fibo expansion level, and as well as the upper limit of this ascending channel. All right, and so this currently is still holding pretty firmly at the 20-week MA. Okay, now last one, German 30, okay, which is DAX. So German 30 DAX over here is imprinted all-time high at 15,329. So on 6th of April. So the time when I do my Q2 outlook, so expecting a push up to 6,685, then thereafter 17,800, using 13,180 as my long-term pivotal support. So yes, it actually inched much higher. Okay, inch much higher. So what I could see now is actually attempting to break out this long-term bullish ascending channel resistance on the monthly chart. RSI pretty positive, broke out from this descending resistance. Actually no observation at the moment, doesn't indicate any change of momentum, still positive, hasn't reached the overbought region yet. So for this quarter, what I do over here is that I would actually tighten the key long-term pivotal support level to 13,600, which is the former range resistance of 12 January 2018 that was tested in Jan 2020. Then before you see the breakdown caused by the pandemic. So now this turns into a pullback support level, which is the 50-week MA. So this will be my key pivotal support for this quarter to maintain my bullish bias for the German 30 to actually shape that further potential push up towards 16,850, then thereafter 17,800 slash 18,120. All right, so this will be the RSI is still pretty healthy. All right, there's no kind of clear divergences. So still a bit of room to push up before hitting the extreme overbought level at 79% that was seen in December 1999. Okay, 79% level. So what we could say over here is that momentum hasn't really overstretched yet on the German 30 index. Okay. Okay, so now let's take a look at FX. Okay, so on the FX space right now, what we could see over here is this chart that I share with you all very quickly, right, is the performance, year-to-date performance as of 25th of June. So if this chart if all the lines is going up, that means the currency is outperforming the US dollar. Okay, so what you see right now is year-to-date Canada dollar is outperforming the USD at 3.5%. Okay, the next one will be your sterling pound outperforming the USD at 1.5%. Then your Chinese yuan, offshore yuan outperforming the USD at 0.67%, then followed by Australia, Singapore, New Zealand, Euro, then Swiss franc. Then the one that is kind of underperforming the USD is the Japanese yuan, which is at negative 6.9%. So if you look at almost all the currency, right, especially this top three here is outperforming positively. If you look at the last 3 years here, is even though the Australia, the Sing dollar, the New Zealand dollar, and the euro recently towards somewhere around mid of June over here, it starts to inch up higher. So indicating to us, hey, the dollar's strength underperformance against the Aussie, against the Sing, against the Kiwi and Europe has starts to come back into play. That means these currencies are solely outperforming the dollar. So we're talking about potentially dollar weakness is still kind of prevalent in the marketplace. All right. So before I talk about this, let's take a look at this this pair, this USD per Chinese yuan. So if you look at this movement here, since March last year, this blue line is going up. Okay, going up slowly. So what it means that this blue line is going up, what it means that over here is that the yuan is actually strengthening against the dollar. So this yen strengthening against the dollar over here is actually supporting further upside move in emerging market shares and Asia ex-Japan shares, as indicated by the ETF, these two ETF here. So if you look at over here, since the start of this year, there is a bit of dollar strength coming back until end of somewhere around April. Then you see a bit of lackluster move on the emerging markets, and Asia ex-Japan stocks also start to come down a fair bit. And lately, it starts to move back up. And the reason why it moved back up over here is because after around April, late April, the yuan, the Chinese yuan starts to strengthen against the dollar again. Okay, so after that, then recently it just fall back a bit, but it hasn't break above this low over here. Okay, so if you look at the correlation, right, there's a direct correlation between the yuan strength, yuan versus means the yuan currency versus the USD, and the AXJ at 0.5 around there, halfway mark, correlation of 0.58. So it's pretty still not very strong, but still pretty positive. So what it means that over here is that if we start to see further strengthening of the Chinese yuan versus the USD, it may potentially support further share price movement in emerging market stock and Asia ex-Japan stocks in general. All right, in general. So now let's take a look at the technical chart of the Chinese yuan. Okay, whether would there be chance of it coming down further, going up against the USD? So what I plot now is the general plotting with USD versus Chinese yuan. So what it means that over here, 1 USD equals how many Chinese yuan? So as long as this chart is going up, that means US dollar strengthening. If this chart is coming down, that means dollar is weakening, yuan is strengthening. So you look at it recently over here, it actually break down the ascending channel support, long-term ascending channel support, bounce back up, hit a low of 6.35, bounce back up, and now it's retesting this line at 6.40. All right. So what we could see now over here, yeah, potentially it could be a bit of big sideways. So I have a key resistance at 6.68. So as long as this 6.68 holds, right, we may start to see further dollar weakness against the Chinese yuan. That means Chinese yuan still potentially it could strengthen further into Q3, potentially, which if I look at the correlation between Asia ex-Japan stocks and emerging markets, actually supporting these two markets. All right. Now going to the FX market, right? So the outlook of FX market all dependent on euro dollar, because euro dollar is one of the most liquidly traded pair. So Adam, in Q2, right, I'm still expecting it to be pushing up to the top of the range, which is 1.255 level, the swing high of February 2018. All right. So what we could see now, right, pretty much unchanged. So since the bullish breakout of this long-term ascending channel, okay, in November last year, it started to trade big sideways for 7 months, no change. So what we could see now, right, yes, we may see a bit of dollars weakness into the market for Q3, but I don't expect it to actually be very, very strong dollar weakness unless this 1.255 level breaks on the euro dollar to take a much higher. So what we could see right now, right, for Q3 outlook on the euro dollar is still no change. I'll be using 1.1650 as my key pivotal support level, still looking for a potential churning move to test the 1.255 level, the range top of this whatever double bottom we call it. Until if this level start to break, then we could see more substantial dollar weakness. Okay, or else it will be something like a push up, then thereafter just go sideways again. Okay, on the FX. So FX market is more like a big sideways range. Unless the euro dollar could do a bullish breakout of 1.2555 before we could actually see more substantial dollar weakness into the market in Q3. All right, so now the last one I want to cover will be the dollar CAD. Okay, so dollar CAD, right, is one of the strongest currency against the US dollar. Why? Because technically, right, it start to shape this impending double top formation. Okay, all right, with a neckline support at 1.2070/12060. Okay, so what it did over here, it actually came very close. Okay, this was my Q2 outlook. I'm still looking at this neckline here. Then a test of the neckline, because of the oversold level, then we may expect a bit of sideways movement or bounce before coming down. So that was my expectation for Q2. So indeed it happened. It actually test the neckline support and it shaped that bounce. So what I could do now over here is that I actually tighten the resistance to 130, 1.3020 over here. We saw this region over here before the breakdown takes shape. So I'm still looking for maybe a potential a bit of bounce towards 2635, maximum 3020 before another down leg takes place with a weekly close below 1.2060 to take it down lower to 1.1220. Okay, so this one here I'm still expecting a bit of weakness. That means the one that is more pronounced weakness versus the dollar, more pronounced dollar weakness inside the dollar CAD, and also supporting by what I call a firmer oil prices as well. Okay, so I'm still expecting the Canada dollar to actually continue to actually outperforming the peg. But in order to see substantial dollar strength, definitely the most liquid, substantial dollar weakness, we got to see the euro dollar breaking up that 1.255 level. All right, but in terms of the various pair, if you ask me technically which pair potentially that could actually still outperform the dollar would be Canada. All right, now moving on to, okay, so this is the Bloomberg. Okay, very quickly, let me talk about oil futures. So crude oil, so this is the last one with the commodity prices. So I'll touch on oil. gold and silver. Okay, so this is my Q2 outlook for crude oil. So crude oil at the point in time bullish. Why? Because of the positive momentum. To reinforce, you got to break this 666 level, 66.6, then going up to 75, 70, 87 level. So at the point in time, that was my view. So what I did over here, it did a weekly close above 66 2 weeks ago, and now it's approaching the first resistance at 75, 70 slash 87. So what I did over here is there's no sign of bullishness, bearishness on the RSI. RSI still moving to push up. So what we could see over here is potentially, right, after hitting the first resistance zone at 75, 70 slash 87, maybe a bit of pullback. As long as hold above 57.25, potentially we could see another round of push up to 103.90 slash 1110. So that is the range top previously that was formed over here in 2010 to 2014 before the multi-year down leg take shape. So this is the very important resistance over here. So if this level start to break, what we could see is a super cycle in oil. But until then, I will not know whether it will break or not. And also substantially, right, what we could see now going forward in the near future, we talk about next 10, 3 years, 5 down the road, there'll be more usage of renewable energy. So if that starts to take shape, right, there'll be lesser demand for oil price. All right. So at the moment, we're still looking at 103.90 slash 1110. Unless this level starts to do a breakthrough, then we're talking about a more pronounced super cycle in oil. Okay, so now talking about gold. So gold at that point in time, it actually hit this inflection level, a key support 1670 slash 40, where we still expecting kind of push up toward 1965, then thereafter 2075. So what we see over here is that yes, it actually did that push up for gold over here. Okay, so pretty nice move for gold. It actually did. So now after that, close about it almost hit the 1965 level, but thereafter it did a pullback and now retesting this support line again with the 100-week MA. So I could see still no change. I'm still using 1670 slash 40 as my key support level. So for Q3, potentially still looking for that potential push up to retest 1965. So unless it could break that 1965, a weekly close above it, then we could see a more substantial push up in gold price. All right, so it's more like a range player now for Q3. So that also applies the same for silver. So you look at silver, right? Previously in my Q2 outlook, we actually mentioned it's actually consolidating in a kind of ascending triangle with the resistance at 29,086. Okay, so what it did so far, it actually toggle between this line, and right now here, I'm still expecting to actually go within this range unless you're able to break out above 2986, then we're talking about further upside. So this 2986, right, is equivalent to your goal of 1965. Okay, almost a parallel level. So it's more of a sideways range play for precious metals, for silver and gold. All right. So with that, I've kind of take you through the whole technical outlook for Q3 from stock indices, FX, and as well as the three major commodities: oil price, silver, and gold. Okay, so now Q&A time. All right, Q&A time. So let me go through because there's some questions that I could actually answer for you all. Okay, let me start from the top. Okay, first question. Why is the reason gold and silver are negative? So I believe that this question is bearish, right? So one of the reasons is technically I share with you is the lack of momentum because gold and silver hasn't break their key resistance level from a technical picture because this is a technical person I look at it. Why? Because we got to be very objective. What is the level before it breaks to come in momentum? So the momentum is not there yet in terms of the long-term process. We talk about multi-month up move, right? Because it didn't break above, gold hasn't break above 1965 and silver hasn't break above the 29.85. Okay, so that's a technical reason. Then another aspect is fundamental reason. Okay, so the fundamental reason why gold and silver are kind of negative or underperforming the commodity prices because there's this fear factor at play is where the global central banks may hike interest rate. Okay, so once they start to hike interest rate, it will actually doesn't benefit gold because in terms of competing asset, gold and silver, if you hold gold and silver, they will not give you any interest income versus parking your money in some fixed income deposit. So there's this trade-off. And also why gold doesn't crash, because if inflation was to come in, gold and silver will provide a hedge. So now it's a battle between these two forces as an inflationary hedge, and as well as the risk of opportunity costs if interest rate hike cycles start to come in sooner than later, where holding gold doesn't give you interest income, and silver as well. So that's why they're stuck between these two range, this range at this point in time. All right. So okay, the next question. Why would rising commodity prices cause a crash in the S&P? Okay, same thing. Like we explained earlier, right? Inflation goes up, but what causes inflation to go up? Okay, consumer price index goes up. What causes consumer price index to go up is because businesses has a higher cost, right? So if business has a higher cost, they cannot maintain this cost, they got pass down to consumer. So that's why consumer prices goes up. So what causes business costs to goes up is your raw materials, which is your commodity prices. So commodity prices is the primary source that causes the inflation change to happen. All right. So commodity prices, if it start to go up higher and higher without any control, there will be, that means at the end of the day, our purchasing power as a whole will goes down, right? Agree? Because if inflation keep going up higher and higher, so to prevent commodity prices from going up too high, if somebody got to come in and stop this from happening. All right. So once somebody to stop this inflation pressure coming is global central bank got to make money less cheap, make it more expensive. So the how is money being priced is by interest rate, right? So if interest rate starts to goes up, at the end of the day, people will spend lesser, so there will be reduction in purchase of goods and services to control inflation. This is how they control in a very simple way. Then why it will cause a crash in the S&P 500 or equity prices? And in fact, I want to answer is it may cause a steeper crash with a little hike of interest rate right now. Why? Because if you look at the last 10 years, there is a lot of debt inside the system. That means there is a lot of leverage in general as a whole. Because why? Because money is so cheap, 0% for the last 10 years. So at the end of the day, people has a psychology belief that interest rate will remain low for a long period of time until the central bank start to hike its first inflationary cycle. And why they believe that inflation will be being so low? Because of the deflationary forces that is being supported by technology stock that is pushing your inflation to come down, because technology actually is thrive on deflationary forces. Why? Because technology improves productivity. Once productivity goes up, everything your cost of goods produced will actually start to come down. And right now we start to see a change of this picture by a sudden spike in commodity prices. It could be speculative driven, it also could be fundamentally driven because of the pandemic, and as well as fiscal policy coming into play. Okay, so this is the easiest way I could explain. Okay, is looking at the US 10-year yield good enough for, okay, is looking at the US 10-year Treasury yield good enough, I believe, as a gauge for looking at liquidity? Uh, I would say that the US 10-year yield is actually not, okay, it's not really a gauge about liquidity. So liquidity, you got to look at financial condition index, which is actually it could be the spread of corporate bond yield versus the treasury yield. This is one of them. So the US 10-year yield in terms of the absolute value, in terms of the rate of change of the US 10-year treasury yield, is more of a gauge of long-term growth and the risk of inflation. Okay, so this is what I use the US 10-year treasury yield for. Okay, then okay, okay, let me go down. Okay, market believes the fact that inflation is transactionary. Okay, so to me, how do how do I gauge whether market believes the fact that inflation is transitory or not? Is I look at the price action of the markets at this moment in time. Okay, so if we look at the 10-year yield minus the 2-year yield, so it seems to me that number one, the 10-year minus 2-year is coming down. Okay, so what markets actually believe right now is potentially two things actually happening in play. Is inflation itself may not be transitory because the 2-year is actually going up at a faster rate versus the 10-year. So that's why the 10-year and 2-year is the spread is coming down. So if the 2-year is going up over here, that means what they're expecting is, because the 2-year yield is actually very sensitive more to the Federal Reserve rate high. Okay, so what they believe that over here is that the inflation itself, market participant doesn't believe that the inflation is transactionary. All right, so what it means that over here is, but what markets believe that at this point in time, if the Fed were to take action, it may start to calm down inflationary expectation. Okay, this is what it means. Why? Because if you look at the 10-year and 5-year break-even rate, it's actually coming down from May high. All right, so this one, let me share with you all. Let me go to one page. Okay, I'll share with you about this inflationary thing. Okay, so very quickly, if you want to measure inflation, right, you can look at the 10-year break-even. Okay, and the 5-year. These are the two. Yeah, everybody can see my screen, right? Okay, no mind. Let's go to the 5-year first. Okay, so if you look at this is the 10-year break even. So you realize that since May, right, the 10-year break even inflationary rate is coming down. So what it means that inflation expectation has starts to come down. All right. So what it means over here is market actually believe that, hey, the inflation is not transactionary, but however, with the Fed getting a bit hawkish, as explained by the 2-year yield that is going up, it may start to calm down future inflationary expectation. This is what the market believes in at this moment in time. All right. Okay, so someone asked me in your slide 13, the Bloomberg Commodity Index versus the S&P 500 show divergence. Seems that there's a signal that equity downtrend is approaching. But after all, the index, the US indices, you are actually expecting they are going up to break higher. So what does it mean? Is equity going to turn higher or are they going to down soon? Okay, so what it means that over here is, yes, there is a warning sign. Okay, let me go to my first slide. Okay, there is a warning sign over here, this negative divergence that's being formed. Okay, but this warning sign over here at this moment in time is only so far 3 months versus the rest of the divergence we take at least on average of 10 months. Okay, 10 months divergence before the market top. So what we could see right now, right, based on these statistics over here, we may start to see potentially further move up on the global stock indices. But however, this is at the risk we may start to see approaching. That means we are talking about borrowed time. We are on borrowed time that we may start to see the tail end of it. Why? And also you look at the sector rotation play. So if you look at sector rotation play, right, previously the last quarter was actually a performance of cyclical and energy into the play over here. So right now, this time around, we see a potential move towards technology. All right. So which is considered as a bit of defensive stock as well. Defensive tech. Why? Because we're talking about tech itself is also considered as a new defensive. Why? Because of what we see last during the pandemic scenario. Okay, so what's interesting over here is that yes, we're on borrowed time. So I still expect a bit of move up. So until if we start to see what we call potential movement up on, let's say, cross asset classes like dollar strength starts to come into the market, means there's no dollar strength yet, so it's still supporting of the equity prices, still risk on at this moment in time. And if we will start to see a sudden spike up in the US 10-year yield, that means we're talking about the yield start going up higher and higher again. That means there could be a risk, or what I call a risk where market might overshoot the Fed expectation of interest rate hike. Okay, so that doesn't seem to be happening at this point in time. So what you could see right now is yes, the warning signs are there, but based on the analysis that I did in terms of the divergence, it still have a bit of more time to work up because it's only 3 months so far versus what happened in the past. And also in terms of sector rotation, there is still one more leg to go. That means we need to see outperformance of defensive, which is your utilities and consumer staples. So until that actually happened, the last movement of the sector rotation, then we could potentially say that, hey, this is where that long-term circular uptrend may have ended. So until now, I agree that there's a warning sign is there. So we are still a bit of on borrowed time. And also there's no clear sign of a dollar strengthening. Okay, that is also kind of supporting the risk on behavior for the equity prices. All right. So yeah, so I've answered the last question based on the current chat I have right now. Okay. Uh, so someone asked me about dollar sync. Unfortunately, I have no time to show dollar sync. So hopefully I can post the chart of dollar sync on my Twitter tomorrow. Okay. So what infrastructure stock and ETF in CMC do you recommend? Okay. Unfortunately, I can't recommend any stocks because we do not have an advisory license, but I could share with you infrastructure ETF. You know, for a pure infrastructure ETF will be the industrial will be like XLI. This one you can look at. So if US 10-year goes up towards 2%, okay, so the US 10-year, I have a key resistance at 2.55%. So I'm looking at 2.55%. So if we break above that 2.55% on the US 10-year yield, so this is where the liquidity squeeze might come into play. That means market start to overshoot the Fed expectation of tightening, okay, which is 2.55%. So this is what I'm expecting for the 10-year yield. All right. Okay. Somebody asked me what's my view of Aussie Sing. So unfortunately, due to time constraint, I can't plot Aussie Sing right now. So I'll try to do a bit of analysis on dollar Sing and Aussie Sing that I post in my Twitter account. Okay, so for this, right, this will be recorded. So after that, where do you find the record? Okay, so you can actually follow me on Twitter. So let me very quickly go to the Twitter. Okay, so this will be my Twitter handle. So you can actually follow me at Kelvin City, no, at Kelvin SC Wong, at Kelvin. You just open a Twitter, sign up for Twitter account at Kelvin SC Wong. So once you find me, just follow me, and there's a notification button. You can on the notification button. So once I post any new post on Twitter or on a tweet every day or whatever my stuff, including some market commentary every morning, so you can actually be notified. All right, so I will post the video over here as well, today's video. And also you can find other content, which is my weekly outlook on the global stock indices, the S&P, the Nasdaq 100, the German 30, the Nikkei 225, and the Hang Seng. These 5 I cover every Monday for a week ahead kind of outlook based on a technical approach. Over here, CMC. So you go to CMC Market Singapore, just click on subscribe. So you can click on Market Outlook. So this is where you see a whole list of weekly technical outlook. Okay, so for those who wants to look for educational video on technical analysis, which I did as well, 10 videos so far. Okay, so you could go over here. Where is it? Yeah. Uh, where is it now? Okay, you go playlist. Okay, click on playlist. You could go to get started in trading education. Okay, click on it. Okay, so over here, you see this series of trade the markets like a pro, 1 all the way to 9 so far. So I'll produce 10 hopefully by this week. So it covers through basis of technical analysis, indicators, how do I combine them to formulate a trading strategy. So answer today's topic seminar, what I share with you all is a bit deep because I'm a strong believer in technical analysis. Why? Because they give us reasons, a very objective reason to be bullish and bearish rather than using pure fundamental. And it also gives us a bit of edge in terms of giving a what I call more precise, timely outlook based on the level that we have. All right. So with that, thank you for your time. So I hope that I could answer as much question as possible. So one question I want to go because someone asked me about not clear that are you on Telegram? Unfortunately, we have a CMC SG Telegram. You can actually follow on it. Personally, I still me and my colleague will post on the CMC SG Telegram. All right. So one more last question. I think this I got to be very clear. Squeeze meaning that US equity will come down. Okay. So what I said earlier on Q3, my Q3 outlook, the US equity is still bullish based on the key support it must hold. So we are still expecting based on the technical approach, the trend is still bullish. All right. So the trend is still up. So I still got to respect the trend, except that right now we are on borrowed time due to the divergence that we start to see. I shared earlier on the S&P and Bloomberg commodity index. Okay. All right. So thank you for your time. And I hope that I could actually see you all in my next video again as soon as possible. So do actually follow me on Twitter to find out more updates of the market, and also follow CMC YouTube channel to get more educational, excellent content from that. So have a great evening, and thank you for your time. And do look out for the recording on this video out on my Twitter handle, and as well as CMC SG YouTube channel tomorrow. All right. So thank you and have a pleasant evening ahead. Goodbye.